Michael, what's your metaphor for the GameStop meme stock trade? Is it like running into a burning building or something else?
I'm more of an observer in all of that. I will tell you, my 19-year-old daughter, was asking me yesterday whether she should sell the remainders of her GME, and I said yes. And I think she wisely only took half my advice, just sold a little bit. But yeah, I mean, honestly, I think you're dealing with. It's very hard to really come up with a real classically to come up with a valuation for GameStop, at the numbers that it's been trading at today and yesterday and so forth, that to me resonates, right? And I think one thing that just is your guest was just discussing, like what is this gambling or is this investing and all that. And I think there's a lot of confusion about what is really happening there. There's a lot of people who are making money in it, but there's also some very valid investment cases in GameStop. Someone told me that there was a case running around on WSB for like a $30,000 share price there. So I think I think new investors just have to be really step back and just realize that this kind of frenzied activity. What happens is narratives start taking over, and the laws of sort of financial physics ultimately will reassert themselves at some point. So you just recognize what you're working with. If you want to be, trading volatile stocks, that's fine, but just make sure you have stop losses and so forth in place.
All questions we're going to ask Robinhood CEO Vlad Tenev when Studio 1.0 starts at the bottom of the hour. What is your broader long-term view on tech and its weighting in your portfolio? Do you think we're at the beginning of a longer term correction here, or is this a blip and things are going to keep going up?
Well, my view right now, we've seen a lot of sensitivity of tech stocks to interest rates, with interest rates climbing over the last few weeks. And that correlation, the factor pair correlation with 10-year interest rates, for example, has skyrocketed there. My view is that the interest rates narrative is really overblown. And I think it's also misinterpreted. It's not really about your discounted cash flows being worth less because the risk-free rate has gone up. It's more to do with the fact that, like, if you look at the NDX, that nominal earnings yield spread to the 10-year treasury yield is a lot tighter than it is in other indices. And at the same time, in value indices or cyclicals, those baskets are looking at very, very large earnings acceleration. So that's going to provide even more buffer for that sort of relative value to treasuries argument. With all that being said, I think over the next several months and probably throughout the rest of the year, I think you're going to start seeing a lot more bifurcation where the big established tech companies, the Microsofts, the Amazons, and the Googles really reassert themselves, and some of the real story stocks kind of decouple, and some of them will be probably amazing, and a whole bunch of them will probably be a lot less than amazing. So I think it's really important to bifurcate, established cash flow, established position companies that are sort of dominating the high end of the NDX versus some of the really, really interesting and potentially very valuable companies down the road, but the the valuations associated with them have been very, very stretched. So right. I would expect that to be some polarization within tech that way.
Now, Roblox had a good day, but if you look at recent SPACs, recent IPOs, they've been slumping compared to, Bumble, Airbnb, both of those companies doubling on their opening days. I know you were listening in when I spoke with Cathie Wood the other day. She sort of encapsulates what is so controversial about this market. Curious what your thoughts are on her strategy, obviously making big bets and staying committed to names despite pullback across the board.
Right. Well, I mean, I think one thing that's clearly been talked about a lot is just that when you're in the structure she's in, she's not at a venture capital firm, she's not at a private equity firm with locked-in money, she's in a liquid vehicle. So liquidity risk is really, really important. They're particularly for the smaller, less liquid names, right? And so, if investors are expecting the convenience and liquidity of an ETF, there, but the names in there are scaling fast in terms of the amount of inflows and capital that's being invested in those companies. You just have to, at some point, it's just a recipe for some nasty downside performance, not just for that ETF, but for those names itself. Simply, she may be a forced seller if she does get sustained redemptions, which she really hasn't so far. So that's one thing, and I think it'd be nice to see how she's really thinking through liquidity management as she scales her ETF. On the other hand, I thought she made a very good point in your interview about the fact that look, growth versus value. Well, so many value stocks, right? Whether they're banks or whether they're energy companies or so forth, are facing massive structural change thanks to technology, right? And so, I've seen this over and over again with my clients that are value investors where they underestimate that. And so I think she made a really, really good point there.